Imagine waking up to a 311 billion yen hole in your bank account.
Yeah, that is, I mean, that's game over for most people.
Right. For almost any business on Earth, a wound that deep is just a fatal blow. It's the end. But for the company we're analyzing today, that staggering loss was, well, it was exactly the catalyst they needed to pull off what might be the most ruthless corporate pivot of this decade.
Oh, absolutely. It's a phenomenal case study.
Welcome to the deep dive. Today on the Japan Stock Podcast, we are taking our stack of market analyses, operational data, and we're unpacking the aggressive V-shaped recovery of a true Japanese industrial titan. We're talking about the Sumitomo Chemical Group.
And for anyone listening right now, if you're trying to understand the future of global supply chains or geopolitical maneuvering, high-tech manufacturing, this is a narrative you really cannot afford to ignore. We're looking at a company that took a massive existential hit to its legacy business model. I mean, they suffered deep financial scars. But instead of bleeding out, they're forging those very scars into impenetrable armor for the future.
Yeah, turning a liability into a weapon. So today, our mission is to decode the hard data behind this turnaround. We're going to figure out how they engineered this recovery, what their new economic moat looks like, and we'll get into this later, the massive risks still hiding just beneath the surface.
So much risk. But let's start by establishing their true identity.
Yeah.
Because we really have to correct a major misconception right out of the gate.
I know exactly what you're going to say.
Right. If you hear the name Sumitomo Chemical, your brain probably just instantly defaults to images of smokestacks, vast refineries.
Huge vats pumping out generic bulk plastics.
Exactly. And historically, you wouldn't be wrong. But that identity is entirely dead. Today, they are actively and just relentlessly shedding their reliance on basic petrochemicals.
Yeah, they're pivoting towards something way more complex.
Completely. When you look at the recent data, you are looking at a 2.6 trillion yen behemoth that is fundamentally rewiring its DNA. They're moving aggressively away from low-margin commodities and diving headfirst into high-margin, highly specialized sectors.
All right, specifically their Agro and Life Solutions segment and their ICT and Mobility Solutions segment.
Yeah, and if you look at the latest figures, those two advanced segments alone now make up 44% of their total sales.
Which is huge.
It is. They are structurally not the company they used to be.
Let's translate what that 44% actually looks like in the real world, just so you listening can visualize how deep into the tech ecosystem they really are. If the global tech supply chain is, say, a cutting-edge $1,000 smartphone.
Okay, I like this.
Sumitomo is not the shiny glass screen you tap. They're not the sleek titanium case. They are the invisible, microscopic architecture inside.
Oh, that's a great way to put it.
Right. They are the molecular photoresists that literally allow the microchips to be printed. They're the high-purity alumina that makes the vibrant colors on an OLED screen physically possible.
So they've basically moved from the commodity basement of the global economy straight up to the penthouse?
Exactly. But before we celebrate this pivot, we have to look at why it happened. Because companies of this size do not just willingly abandon their historical cash cows.
No, they certainly don't. They abandoned the legacy model because they crashed into a brick wall at 200 miles an hour.
Yeah, let's talk about that 2023 crash.
If we open up the financial data for fiscal year 2023, you see the massive scar we mentioned earlier, a devastating net loss of 311.8 billion yen.
And we have to understand why that happened. The global market for basic petrochemicals, things like ethylene, which is the building block for cheap plastics, it became fiercely oversupplied.
Right, you had these massive state-subsidized mega plants coming online in China, just completely flooding the market.
And a Japanese plant operating with much higher energy costs simply cannot compete on price in a race to the bottom. That 311.8 billion yen loss wasn't a fluke or a bad quarter. It was the structural collapse of their old way of doing business.
That is the brutal reality of commoditization. I mean, when what you make can be made by anyone, the only thing that matters is price. And that is a miserable game to play.
Which brings us perfectly to the new game they're playing. Let's look at their competitive landscape, their virtual battle against global rivals.
Yeah, let's get into the moat.
Right. While a lot of their peers in the chemical sector are still stubbornly fighting those brutal price wars over generic materials, Sumitomo has fully committed to hyper-specialization. They're building a massive economic moat.
They are, and the data gives us two incredible pillars of this new moat. The The first is their methyl methacrylate, or MMA monomer production.
Okay, break that down for us.
So this is a critical chemical used in everything from transparent plastics to light guide panels for screens, automotive parts, you name it. Sumitomo hasn't just continued making it, they have completely optimized the efficiency metric.
By building out their international nodes.
Exactly. They've established a highly strategic dual-node production system in Saudi Arabia and Singapore. Their facility produces 50,000 tons per year on a single continuous line.
Wow.
Yeah, that makes it the most highly efficient production facility of its kind anywhere in the world.
So hold on, let me stop you there and view this from an investor's perspective. Even if it's a highly efficient process, MMA is still ultimately a chemical. It's a physical product.
Sure.
So if I'm looking at a 3 to 5 year horizon, why shouldn't I worry that a competitor in an emerging market is just going to reverse engineer their highly efficient process, build their own plant, and undercut Sumitomo on price anyway?
It's a totally valid concern for bulk chemicals. But that brings us to the second and arguably much more critical pillar of their moat, back-end semiconductor materials. Specifically, extreme ultraviolet, or EUV photoresists. This is where reverse engineering becomes basically impossible.
Because it's too complex.
Exactly. EUV lithography is the process used to print the absolute smallest, most advanced circuitry on next-generation microchips. We are talking about drawing lines thinner than a single virus.
That's insane to even think about.
Right. You do not just mix chemicals in a vat to create an EUV photoresist. These materials have to be engineered at the molecular level.
Yeah, they must react perfectly to incredibly short wavelengths of light.
Exactly, and withstand extreme manufacturing conditions without a single molecular impurity. If your photoresist is off by even a microscopic fraction, the entire batch of 3-nanometer chips is ruined.
Ah, okay, so the mechanism itself is the defense.
Yeah.
If you're the massive global tech giant, say, fabricating the next generation of AI chips or a high-end OLED tablet, you do not go bargain hunting for your chemical architecture.
No, the cost of a yield failure on a silicon wafer is astronomically high. You need absolute flawless precision. You aren't looking for a 2% discount, you're looking for guaranteed perfection.
Precisely. And Sumitomo has brilliantly capitalized on this dynamic. They've locked in a highly secure dual supply system across Japan and Korea, dealing directly with the world's leading semiconductor makers.
They're no longer just a vendor dropping off barrels at the loading dock. They're a deeply integrated partner in the chip design process.
Right, evaluating these advanced materials at their expanded facilities in Osaka to ensure absolute perfection before the material ever touches a client's multi-billion-dollar fabrication plant.
To visualize that for you listening, while their legacy competitors are fighting over pennies in a crowded, noisy grocery aisle selling bulk plastics, Sumitomo has quietly set up an exclusive mandatory toll booth on the highway to the next generation of global technology.
I love that analogy. A mandatory toll booth.
Yeah, if you want to build an advanced semiconductor, you are going to pay the toll for their molecular level photoresists. That is a truly formidable moat.
It is, but as strong as a technological moat is, it only protects you from corporate competitors. It does not protect you from macro geopolitics.
Oh, here we go.
Yeah, let's look at the friction points of their international business, because this is where the risk matrix starts flashing red. Right now, a staggering 69.9% of Sumitomo Chemical's revenue comes from overseas.
That is a massive level of global exposure. It makes them highly vulnerable to forces completely outside of their control.
Let's break down that geographical data, starting with their biggest opportunity, the Asian market, specifically dominated by China and India.
Right. This region accounts for an enormous 36.9% of their total sales, which translates to over 962 billion yen.
And they haven't just exported to Asia. They've built a highly robust, localized footprint.
Exactly. They have electronic materials bases actively operating in key Chinese tech hubs like Xi'an and Changzhou. By localizing their supply chain, they keep themselves physically close and deeply integrated with an exploding demand for high-tech components, EV batteries, display panels.
But there's a very dark cloud hovering over that 962 billion yen Asian engine. North America accounts for 16.1% of their sales, and we have to factor in the reality of U.S. trade policy.
Right.
Regardless of where you fall on the political spectrum, the undeniable momentum in Washington is leaning heavily towards strict tariffs and aggressive export restrictions on high-tech goods heading to China.
Yeah, you can call it the Trump effect, but it's really a broader bipartisan shift.
Exactly. And here is the preemptive warning for anyone analyzing this business. Sumitomo's EUV technology and advanced semiconductor materials are the textbook definition of highly sensitive, dual-use technology.
Right. Dual use meaning it's vital for consumer electronics, but equally vital for advanced military applications and AI development.
So if the United States government decides to tighten the screws and heavily restrict what specialized semiconductor materials can be sold to Chinese tech firms or used in Chinese foundries, Sumitomo is caught directly in the crossfire.
Yeah.
Their molecular moat suddenly becomes a geopolitical liability, and that massive Asian revenue stream could be severely throttled by sanctions they have zero power to fight.
Yeah.
Just let that sink in for a second.
Yeah. It's massive. The gravity of that threat really cannot be overstated.
Yeah,
I mean, a stroke of a pen in Washington could freeze a massive portion of their market.
absolutely.
But let's simulate another macro scenario, this time on the supply side.
Okay.
We talked earlier about their essential and green materials segment and their highly efficient MMA production. That efficiency relies fundamentally on a joint venture in Saudi Arabia to secure cheap feedstock and fuel.
Right.
It is the absolute bedrock of their cost competitiveness in that sector. So what happens if there is a sudden persistent blockade in the Strait of Hormuz?
The entire supply line chokes.
Instantly. If that geopolitical flashpoint ignites, their supply of cheap raw materials evaporates overnight, which raises a really fascinating, almost uncomfortable question about their corporate philosophy.
Pardon you?
Well, they have this grand long-term vision of becoming a carbon-neutral, innovative solution provider, right?
Right.
But when you look at the raw data, is that green transition secretly and dangerously reliant on the cash flow generated by cheap, vulnerable Middle Eastern fossil fuels? If that pipeline stops, does their capacity to fund their own technological evolution stop with it?
Wow, yeah. That is the exact kind of systemic cascading risk that never shows up neatly in a standard quarterly earnings projection.
Never.
And while we're on the topic of systemic factors, we have to talk about the currency engine. Because when nearly 70% of your business is overseas, you are essentially a hostage to foreign exchange volatility.
Oh, the yen.
Yes, over the past few years, we've watched the Japanese yen swing violently. It moved from the quiet 110 range to 144.59 and spiked all the way up to a 152.62 against the US dollar.
To put the math of that into perspective for you listening, when 70% of your sales are overseas, a 10 yen swing in the exchange rate is not just a rounding error on a spreadsheet.
No, it's a massive tidal wave of capital.
Exactly. A heavily depreciated yen means the profits they make in the US or China translate into significantly more yen when repatriated back to Japan.
Right, and that kind of extreme currency volatility can literally hide severe operational failures on the factory floor. Or it can artificially inflate a mediocre quarter to make it look like an incredible success.
If you want to know if the company is actually healthy, you have to mentally strip away the FX impact to see if the core engine is actually running efficiently.
So let's open up that engine room right now. Let's link this operational pivot and these global dynamics directly to the hard numbers, because the financial causal chain here is breathtaking.
Let's do it.
Remember that devastating 2023 loss we talked about? The 311.8 billion yen wound. Let's look at the V-shaped recovery in the latest materials released just a few weeks ago in late April. In just a single year, the return on equity, or ROE, clawed its way back from a staggering negative 29.2% to a positive 4.1%.
That is sheer whiplash.
It is. And if you look at their earnings per share, the EPS rocketed from a loss of 190.69 yen all the way up to a positive 23.59 yen.
Let's visualize the scale of that math. They didn't just trim the fat. They didn't just, lay off middle management or close a few underperforming regional offices. They engineered a swing in net income of over 350 billion yen.
Which is absurd.
That is the financial equivalent of entirely wiping out the GDP of a small island nation from their balance sheet and then miraculously rebuilding it from scratch in just 12 months.
Yeah, that requires an absolutely brutal, surgical level of operational discipline.
It does, and the data shows exactly how they did it. If we extract the core segments, the reality is very clear. Their essential and green materials segment, the traditional chemical side we talked about earlier, is actually still facing severe margin compression. It is struggling to generate meaningful profit.
But the explosive growth in their agro and life segment completely offset that drag,
Yes, the agro and life growth is fascinating. They didn't just sell more standard fertilizer, they leaned heavily into biorationals.
which are botanical-based or microbial pest control products, right?
Exactly. They target specific threats without destroying the soil biome. Because global regulations on synthetic chemical residues are getting incredibly strict, these advanced natural products command premium pricing.
That makes sense.
Combine that high-margin agricultural tech with the high margins from their ICT and mobility segment, and you have a new, highly profitable identity, literally carrying the dead weight of the old identity.
So if they have engineered this massive 350 billion yen turnaround, the immediate question for any investor is, where is that new pile of cash actually going?
Ah, the $1,000,000 or billion-yen question.
Right, because if you want the unvarnished truth about a company's actual strategy, you do not read their glossy press releases. You read their cash flow statement.
Always.
Free cash flow has successfully recovered to a very healthy 92.2 billion yen. Now, look at how management is choosing to deploy it. They are pouring 145.2 billion yen into research and development, and they're allocating over 131 billion yen into capital expenditures.
Here is where the retail investor needs to ask a very tough question. Are they actually operating with a shareholder-first mentality?
Oh.
Because if you look at that recovered EPS of 23.59 yen, and then you see that management is only paying out a 9 yen dividend,
Yeah.
that feels remarkably light.
It does.
It begs the question, are they hoarding cash to build their own empire at the direct expense of the people holding the stock?
It's the ultimate tension in corporate finance.
Sure.
When we synthesize these capital allocation choices, it becomes incredibly clear that management is essentially checking the obligatory dividend box just to keep institutional investors from openly revolting. But their true religion is CapEx. They are taking the profits from today and aggressively bearing them in the future.
They're betting the entire house on long-term technological survival. They are funding things like regenerative agriculture technologies designed to actively recover natural capital while boosting crop yields, and they're doubling down on expanding that EUV photoresist capacity.
So they're prioritizing a 10-year survival strategy in a rapidly changing world, rather than popping the stock price today with massive share buybacks or a double dividend payout.
Which is a strategy that requires anyone holding the stock to have immense patience.
And frankly, I refuse to just be a cheerleader for this recovery narrative. Professional prudence demands that we look for the blind spots, and Sumitomo has a glaring one sitting right in the middle of their reports.
Okay, let's hear it.
There is a critical data void in their midterm business plan regarding their domestic Japanese petrochemical business. Management keeps using this incredibly vague, sanitized phrase in their public reports. They call for rationalization at existing ethylene plants.
Oh. Rationalization. I know that word very well.
We all do.
Yeah.
Rationalization is classic corporate speak for, we have a bleeding wound and we haven't figured out how to safely amputate it yet.
Yeah, pretty much.
It means those domestic plants are highly inefficient, likely deeply unprofitable, and management knows they need to shut them down or drastically restructure them. But they're conspicuously not giving the market the hard numbers or the actual timelines.
Right, they're stalling.
If you're an investor, you cannot just blindly buy into the V-shaped recovery chart. You have to ask about the severance costs, the union negotiations, and the massive decommissioning costs of tearing down a petrochemical plant. You might want to wait to see those actual shutdown timelines before rushing in.
That is extremely prudent advice. You have to look at the anchors still dragging on the seafloor, no matter how fast the ship appears to be moving.
Exactly.
Well, this has been an incredibly revealing look at a titan in the midst of a historic pivot. We've seen the scars, we've analyzed the new molecular armor, and we've exposed the massive geopolitical risks looming on the horizon.
And as we wrap up this deep dive, I want to leave you with one sharp thought to mull over. We've spent the last few minutes unpacking their incredible technological transformation and their highly fortified molecular moat.
Yeah.
But take a step back and look at the global map. If international supply chains fully fracture between a United States bloc and a China bloc in the next 36 months, can Sumitomo's molecular-level technology keep them utterly indispensable to both sides? Or will their 70% overseas revenue simply get torn in half by a geopolitical war they cannot control?
Something to really think about. Thanks for joining us on the Japan Stock Podcast.
Until next time, keep digging into the data.